Broadcom stock is up over 120% in the last year. The $1.6 trillion market cap semiconductor giant has been riding the AI hype wave. So is now the time to get in, or is it too late to buy Broadcom? Hi, I'm John from ValueGlance.com. I have a PhD in theoretical physics. I worked as a research analyst on an 11-figure fund, and I'm the author of the book Stop Checking the Price, where we explore how to find high-quality companies that are creating value for the long run. Today we're going to be looking at Broadcom, ticker AVGO. So the nonsense news has been gushing with headlines about the Magnificent Eight, lumping Broadcom in with the Magnificent Seven, while the company rides the same AI hype wave that we saw in the past for NVIDIA and others. The stock saw a nice bump after earnings because of increased AI demand and a $10 billion order apparently placed by OpenAI. But as long-term investors, we don't care about the short-term headlines. Let's look at key metrics over the long term to see what they say about Broadcom. So let's start off by looking at profitability. So here we are at ValueGlance.com looking at Broadcom. And what we're plotting over the last 10 years is the ROIC, the return on invested capital, in green, and the weighted average cost of capital in orange. As we saw in Stop Checking the Price, we want a high, steady, and ideally increasing return on invested capital when compared to the cost of capital. That means the business is creating long-term value. Now we can see for Broadcom that it has been cyclical. The latest ROIC we see comes in around 16%, not the highest, but it is trending in the right direction. Over the long term, we do see these ROIC cycles. That's typical of the semiconductor industry. This is not an industry that can move and pivot on a dime. You have to think about long-term supply and demand. It's extremely capital intensive. And so it's not surprising to see that cyclicality. Now we can also go ahead and plot invested capital and the shares outstanding. And what we'll notice is that there are two jumps here. We see one big jump here in both shares outstanding and invested capital in 2016, and a big jump in 2023. So businesses raise capital through equity and debt. Equity by giving out shares, and shareholders buy those shares to raise money. And so what we see here with this jump in shares outstanding is a large increase in equity and equity capital. And so in 2016, Broadcom, actually the previous company, acquired Broadcom and took the name. And so that's why we see that jump there from the equity raise. In 2023, we also see this jump in shares outstanding when Broadcom acquired VMware. And so as businesses raise capital to put that to work creating long-term value, one option for a big company like Broadcom is to go out and acquire other companies. The purchase of VMware was over $60 billion. But when you are at that scale, you can put your capital to work by buying other value-creating businesses. So what does this mean for the ROIC, our key quality metric? So when the invested capital jumps, that means the denominator of ROIC, the invested capital, goes up. And so if profits are the same, we would expect ROIC to come down. And indeed, when we look at Broadcom, we see that after these jumps in invested capital, the ROIC did come down the following year. Eventually, it recovered, and we see that again after 2023, the VMware acquisition. ROIC comes down, that denominator is going up, but then profits do turn around. So even if we don't see the highest ROIC possible here, we do notice it's a trend in the right direction. When the company raises invested capital, puts it to work by buying businesses, ROIC takes a hit, but does recover. This tells us that the company is putting capital to work in an efficient way, and that's what a quality business does. But what does all of this mean for the value? So now let's take a look at the hype factor. So we can click on value here, and what we're showing now is the hype factor in green compared to the equilibrium hype. So the hype factor you can think of as a ratio. It's the ratio of the market price of the invested capital compared to the book price. And so it's a multiplier. It's how much the market is willing to pay extra, a premium, for the company's invested capital. And by looking at this over the long term, the dance with the equilibrium hype, we can see how the market is historically valuing that invested capital. We see that after the latest earnings, the hype factor came in at over 10x. So the market is willing to pay over $10 for $1 of invested capital on Broadcom's books. And if we jump to today, we can see the most recent value after this post-earnings bump push the hype up to over 13x. Now 13x is high hype on an absolute scale, but we notice that going back throughout history here for Broadcom, That's the highest it's ever been. And so we can see this is the highest hype factor, not only on an absolute scale, but historically how the market has valued this business. That means the market is pricing for peak perfection. The company has to continue operating at peak performance to justify this hype factor. Now, as we've seen in the past, a peak hype factor doesn't necessarily mean a massive bubble that's going to pop. It can mean slower growth going into the future because the company simply is not able to keep up with the overhyped expectations that the market is placing on it. We can analyze this another way by looking at the free cash flow yield. So let's go ahead and plot free cash flow yield. So free cash flow yield is another ratio. It's a yield, it's a percentage, which is telling us the amount of free cash flow the company is generating per share divided by the share cost. And so we can see the free cash flow yield has come way down here. And if we jump to today, let's remove these guys. Jump to today, we see a value of 1.4% free cash flow yield. In other words, the business is generating $1.60 of free cash flow for every $100 of share price. Now, if you think of a business as a money printing machine, this is telling us the amount of money being printed by the machine is pretty small compared to the price of money that we had to pay to get the money printing machine. That's what free cash flow yield is telling us. And we can see not only is free cash flow yield low at less than 2%, but this is also a historical low of free cash flow yield. Now, a low free cash flow yield may not necessarily be a bad thing. A company may be investing their cash flow into future value creation. But in the case of Broadcom, we see that since the 2019 acquisition of VMware, the IC, the invested capital, has remained flat. So it hasn't reflected any of that investment of cash flow. So putting it all together, buying in at this valuation is a bet on some serious free cash flow growth. The free cash flow yield is low, invested capital is flat, and hype is at its peak level. Not only a high absolute value, but high compared to the entire history of the business. So the company needs to maintain this peak performance. Now, we've seen from the past acquisitions that they are value creating. The company can allocate capital and create value, as we saw with the VMware acquisition. ROIC takes a hit, but then it does recover. However, when you're at $1.6 trillion market cap, it can be tougher and tougher because of the problem of scale to find these growth opportunities and ultimately turn that into free cash flow. So what do you think about Broadcom stock? Now remember, no one can predict the future, especially in the short term. But by looking at these long-term trends, we can get rid of the nonsense news headlines and see what the fundamental data is really telling us. So invest for the long term and keep compounding knowledge.